Fitch Ratings revises down its growth forecast for China's GDP in 2025 to 4.3%. Morgan Stanley analyst recommends selling the US dollar. And gold is expected to extend its record run into 2025. Welcome to the Economic Bulletin, where we present comprehensive coverage and expert insights on the latest economic trends and developments. Welcome back. We start off with China, where its exports grew by 6.7% in November, down from 12.7% in October. Chinese imports fell 3.9%, the worst drop in 9 months, indicating weak domestic demand. The trade surplus grew to $97.44 billion. The slowdown suggests China may need more policy support as trade risks rise with Trump's potential return to the White House. According to Chinese customs data, China's yuan-denominated exports to Russia dropped 10.5% in November, marking the first decline in 4 months. This was a sharp reversal from the 24% growth seen in October. Meanwhile, imports from Russia also fell 7.4% in yuan terms, deepening from a 4.3% decline in October. The customs agency did not give a data breakdown on products sold or bought from Russia. Chinese President Xi Jinping has expressed confidence that China will meet its economic growth target for the year and continue to be the world's largest driver of economic growth. He also expressed hope that the United States, the world's largest economy, would collaborate with China. Xi emphasized that there would be no winners in tariff wars, trade wars, or technology wars in remarks to leaders of major international economic organizations. Fitch Ratings has revised down its growth forecast for China's GDP in 2025 to 4.3% compared to its previous estimate of 4.5%. The agency also lowered its 2026 growth projection to 4% from 4.3%. Fitch noted early signs of stabilization in the country's real estate sector, but warned that the prolonged downturn in the housing market continues to pose a significant risk to China's economy. The agency also raised concerns about potential trade tensions, forecasting that U.S. tariffs on Chinese imports could rise from around 10% to as high as 35%. Stellantis and China's contemporary Empirix Technology Co. Ltd. have announced a $4.33 billion investment in a new electric vehicle battery factory in Spain. The two companies have formed a 50-50 joint venture for the project, which is expected to start production by the end of 2026. The factory, which holds a potential capacity of 50 gigawatt-hours, will be influenced by the growth of the EV market in Europe and support from both European and Spanish authorities. According to a White House official, U.S. President Joe Biden will caution against further tax cuts for the wealthy and a return to Republican trickle-down economics during Donald Trump's potential second term in what could be his final speech on the economy. Biden will argue that his investments in infrastructure, manufacturing, and underserved communities helped avoid a larger economic crisis and set the stage for continued growth. He will also warn that additional tax cuts for the rich and cuts to social programs would undermine these gains. According to the Recruitment and Employment Confederation and KPMG, UK job postings saw the largest decline in over 4 years in November. Vacancies dropped sharply, particularly in permanent positions, marking the steepest decline since August 2020. The reduction in job openings and an increase in available workers led to the weakest wage growth since 2021. The report highlights the effect of the $50.9 billion tax increases announced by Chancellor Rachel Reeves on October 30, with employers facing a 1.2% rise in payroll levies starting in April, along with a 6.7% increase in the minimum wage. The Reserve Bank of Australia has kept its key interest rate unchanged at 4.35% for the 9th consecutive session, in line with expectations. The previous change in the interest rate was in November 2023. The bank board indicated that recent data on inflation and economic conditions align with November forecasts and expressed growing confidence that inflation is moving sustainably towards the target. Germany's Federal Statistics Office says that the country's inflation rate increased to 2.2% year-on-year in November 2024. This marks a slight rise from October's 2% after 2 months of inflation remaining below the 2% threshold. Inflation in September 2024 stood at 1.6%, and in August it was 1.9%. The inflation uptick in November was primarily driven by above-average price increases in services. In contrast, energy prices continued to have a moderating effect on inflation, although the impact was less significant than in recent months. The Russian Finance Ministry has revealed that its oil and gas budget revenue surged by 25.7% year-on-year in the first 11 months of 2024, reaching 10.34 trillion rubles. This increase was largely driven by higher oil prices. The ministry projects that revenues will remain above baseline levels through the end of the year, supporting positive socio-economic forecasts. Additionally, non-oil and gas revenues rose by 25.8%, reaching 22.31 trillion rubles, with income from major non-oil taxes exceeding expectations. South Korea's central bank governor Ri Chang-yong has said it's unlikely the dollar-won exchange rate will return to previous levels, citing market uncertainty. In a meeting with lawmakers, Ri described the market as being in a wait-and-see mode. The Bank of Korea later clarified that Ri's comments referred to the current situation following President Yoon Suk-yeol's brief martial law declaration on December 3rd, which was quickly lifted after Parliament rejected it. In the MENA region, the Central Agency for Public Mobilization and Statistics stated that Egypt's annual urban consumer price inflation slowed to its lowest level since 2020, recording 25.5% in November 2024. The overall consumer price index for November stood at 239.8 points, recording a slight monthly decline of 0.1% compared to October. The recent slowdown is the first in 4 months, as inflation had been rising since August. According to data from the General Authority for Statistics, Saudi Arabia's Industrial Production Index increased by 5% year-on-year in October 2024, reaching 106.87 points compared to 101.78 points in October 2023. The rise was driven by growth in all economic activities. The index measures changes in production quantities of materials and goods, reflecting the conversion of raw materials into final products for consumption. This expansion underscores the continued growth of Saudi Arabia's industrial sector. The International Monetary Fund expects the Kuwaiti economy to remain in a state of stagnation in 2024 before gradually recovering in the medium term. The IMF forecasts a contraction of the real gross domestic product by 2.8% this year due to additional production cuts by OPEC+. However, the economy is expected to grow by 2.6% in 2025 as these cuts are gradually lifted. According to the IMF, the inflation rate in Kuwait will moderate to 3% in 2024 as excess demand pressures ease and the prices of imported food products decline. The IMF also predicts that the government's fiscal deficit will rise to 6.6% of GDP in the fiscal year 2024 to 2025. The Syrian central bank and commercial banks resumed operations today after all employees were instructed to return to work. The central bank reassured citizens that all deposits in the banks are secure. The statement emphasized the central bank's assurance that deposits and funds held in all operating banks were safe and would not be harmed. A report by Capital Economics has stated that Syria's gross domestic product has declined by more than 85% since the beginning of the conflict, dropping to less than $9 billion in 2021. The report attributed this to the widespread destruction of infrastructure and the displacement of millions of people. The report highlighted that rebuilding Syria's economy will take many years, even if the political situation stabilizes, given the scale of infrastructure damage. It also noted that oil production has dropped to less than 100,000 barrels per day, down from around 600,000 barrels per day in the early 2000s due to the destruction of much of the country's oil infrastructure. Morgan Stanley analysts have recommended that investors sell the U.S. dollar, citing overvaluation and skepticism about the future impact of President-elect Donald Trump's trade policies. In a note titled "Time to Sell," the investment bank argued that much of the positive outlook for the dollar has already been priced in, with expectations for U.S. economic growth and tariffs under Trump being overly optimistic. The analyst pointed out that while trade policy announcements could be swift, their actual implementation is likely to be slower and more limited in scope, with a particular focus on China. As a result, they foresee limited further strength for the dollar. Oil prices edged lower despite support from China's plan to increase policy stimulus, which could boost demand from the world's largest crude importer. Brent crude futures fell 24 cents to $71.90 per barrel. U.S. West Texas Intermediate crude futures dropped 28 cents to $68.09. According to Heroes Precious Metals, gold is expected to extend its record run into 2025, driven by potential interest rate cuts from central banks. The company forecasts gold prices to range between $2,450 and $2,950 per ounce, supported by continued central bank buying, but at a slower pace than in 2024 amid ongoing geopolitical tensions in Ukraine and the Middle East. Heroes also highlighted that economic stimulus in China could boost demand from China and India, further supporting prices in 2025. Gold prices were driven up by escalating geopolitical tensions in the Middle East and expectations of a U.S. rate cut this month, with key U.S. inflation data to be released later this week. Spot gold gained 0.2% to $2,665.04 per ounce. U.S. gold futures rose 0.1% to $2,687.40.
Gold is on track for its best annual performance since 2010, surging over 29% this year. The safe haven asset has been bolstered by central bank interest rate cuts, geopolitical tensions in the Middle East, and China's increased gold purchases after a 6-month pause. Analysts project gold could reach as high as $2,950 per ounce by 2025, supported by global economic uncertainties and sustained central bank demand. Meanwhile, the US dollar's future looks less certain. Morgan Stanley has urged investors to sell the dollar, citing overvaluation and skepticism about the speed and scale of President-elect Donald Trump's trade policies. The expected slowdown in the dollar could further boost gold, as a weaker greenback makes the metal more appealing to international buyers. This dynamic underscores gold's role as a hedge against economic and political instability. As central bank adopts looser monetary policies, the opportunity cost of holding gold diminishes, driving its appeal. With the Federal Reserve and European Central Bank expected to lower interest rates further, gold's upward momentum seems poised to continue. Investors are keeping a close watch on inflation and global economic signals as gold cements its place as the year's standout performer.
Joining us from Washington is economic expert Amgad Atiyah to discuss the latest developments related to gold prices and US dollar. Mr. Amgad, welcome to Q News. We're glad to have you with us on the Economic Bulletin. First off, how do you explain the significant rise in gold prices this year exceeding 29%?
Well, gold, you can say gold and the U.S. entities like the NASDAQ and the S&P were basically the winners of the year. You've seen gold rally from below $2,000 to close to $2,800 right before the election of Donald Trump. I mean, there are many factors contributing to this. As you have mentioned, geopolitical factors, the conflict in Ukraine, the uncertainty surrounding the conflict in the Middle East with Iran, Israel, all of this has contributed to this. Another major factor, in my opinion, also the weaponization of the U.S. dollar by the Treasury Department. We've seen the U.S. imposing severe sanctions on Russia and its allies that have pushed many big countries, mainly China and its allies, to diversify away from the U.S. dollar as the main reserve currency. That have increased substantially the demand for gold. We have also seen investors concerned about the U.S. debt. The U.S. debt has increased over $30 trillion. So a lot of people are kind of concerned and looking to diversify away from the U.S. dollars or add to the reserve currencies or reserve in general to make sure that they are not subject to U.S. sanctions in case it gets imposed on them, and also to hedge against the U.S. debt and any crisis that could be a result of it. We have also seen individual investors and retail, institutional, have all flocked to the dollar, buying physical dollar, speculating in the dollar. So by far, it has been the main winner in terms of trading volume, appreciation. I don't think this will continue much further into 2024. Yes, we expect the Federal Reserve to cut interest rates, but we also expect Donald Trump to reduce the amount of tension geopolitically, whether it was in Europe or in the Middle East. That will take some of the, what we usually call risk premium that was added to the gold. This is why the expectation for 2025 for gold not to exceed the $3,000 or the $2,900, considering the fact that we are now at $2,690, that's only $300 range. So compared to almost $1,000 that we have seen in terms of an increase in 2024. So overall, yes, there will be an increase. Yes, there will be interest in gold. But we expect this interest to subside a bit or moderate in 2025 with the rise of U.S. Stock market because of the interest rate cuts and the tax breaks that Trump has promised in the U.S.
Now, sir, shedding light on central banks, what are the key factors driving central banks to increase their gold purchases?
So, like I said, central banks are, especially China, India, big dollar holders, are concerned with the U.S. debt. That the U.S. budget is basically in a deficit of close to $30 billion, and this is happening on a yearly basis, and there are no hope at this moment to cut this. The other part is they are also concerned with the U.S. Treasury Department. The U.S. government uses the dollar as a weapon. We've seen what happened with Russia. The U.S. froze all their assets, dollar-based assets and reserves. This is a big concern for central banks, especially China, one of the biggest purchases that makes the biggest purchases in gold. This has all pushed those central banks to increase their holdings of not just gold. We've seen also a huge increase in cryptocurrency holdings. We've seen Bitcoin reaching over 100,000. This is all in an effort to diversify away from the dollar. This is why we've seen President Trump not long ago, I think it was last week, talk about the fact that anybody who is thinking to find a common currency, he was actually addressing the BRICS.
Sir, speaking of China, the point you've mentioned, how do you view China's role as the largest consumer and buyer of gold in boosting global demand?
China and India, primarily, they buy gold for consumption, like retail consumption, as well as storage for reserve currency. I see them continuing to have demand for the next year, but I would see this demand moderating as they diversify into other assets. Like I said, cryptocurrency, stock holdings. The Chinese economy is moderating, is actually slowing down. So they will find a way to cut interest rates to try to increase the demand for their local stock market. So they may not be as interested in gold as they were in 2024. But it all depends on how President Trump will deal with President Xi on the economic front. We've heard a lot of talk about imposing tariffs on China. Nobody really knows exactly whether those tariffs will be imposed or this is just a maneuvering move by President
Thank you so much,
Trump.
economic expert Amgad Ataya. Sorry for interrupting you due to the shortage of time. Thank you so much. In markets, global stocks were mixed as tensions in the Middle East remained elevated. In the United States, the futures for the S&P 500 was unchanged. The Dow Jones Industrial Average fell 0.3% and the Nasdaq Composite rose 0.4%. In Europe, Germany's DAX edged 0.1% lower. The CAC 40 in Paris fell 0.6% and Britain's FTSE 100 also fell 0.6%. In Asia, the Shanghai Composite Index gained 0.6%. Hong Kong's Hang Seng shed 0.5%, Tokyo's Nikkei 225 gained 0.5%, and Kospi in South Korea jumped 2.4%. That's all for now. Here's a roundup of today's key headlines. Fitch Ratings revises down its growth forecast for China's GDP in 2025 to 4.3%. Morgan Stanley analyst recommends selling the US dollar. And gold is expected to extend its record run into 2025. That's all for today's economic bulletin on Q News. Stay connected for more news and updates, and thank you so much for watching.